Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current. Welcome, everybody, to Digital Currents. Contrary to some news that is happening on X, Mark is not detained anywhere in an airport or other location. He is traveling. He is totally safe. I am solo today. I am recovering from baby number 2, and recovery is mostly on the sleep and just getting used to the idea of being a dad again to a young infant. And I couldn't be more excited to talk about some of today's headlines. And first, I don't have a Bitcoin stock reveal. I don't have any orange today either, which is a bit of an unfortunate thing. But that's no negative draw on what's happening with the market right now. We've seen a bit of an adjustment occur with Bitcoin specifically. Mark and I spoke about this last week, where we saw a little bit of a rebound on Bitcoin, rebounded to 88,000 before reversing. And we started seeing Bitcoin ETFs saw their longest streak of inflows since January. So we had a really long period of people selling the ETFs, which is increasingly the vehicle of choice for retail to engage in trading Bitcoin. And a couple of things also kind of sparked a little bit of this adjustment. And as we sit now, we record the show, as viewers know, on Friday mornings. And at this time, we've lost a little bit of that gain. We're sitting around 84K-ish. And a couple of things have sort of caused the market to take a little bit of a pause when it comes to some of those gains that were happening on BTC. We started seeing a couple of tokenized U.S. Treasuries hit all-time highs, with particularly BlackRock and Fidelity among the real finance giants pursuing on-chain real-world assets. So it looks like there is just a lot of interest in the overall market, and the price action is currently below that fair value that we've all been chasing. And so we know that, every couple of weeks there's a reset in the options-based pricing, which can cause prices to move when folks either act on their shorts or choose to extend them. And now we saw that a lot of, key milestones are kind of being reached, right? So we saw that 88,000 jump around 8%. ETH also rebounded 9% to 2,100, so still way below what we had been seeing earlier just 6 months ago. And I think this is such an interesting thing when we consider the big two here. Really, when Bitcoin was first released, it was at a V blockchain around. So it was front and center in terms of a area where you can transmit computing processing, right? So using the actual Bitcoin network, but then also obviously the financial exchange over the top. And then of course Ethereum debuted as a real solution towards this problem of really an outdated speed on the network, outdated and smaller size per block, which kind of limited some things that game developers would like to do, or some other app developers over the top. So Ethereum was really looked to be that solution from just an app layer. However, what we started seeing, especially recently, is the rise of other chains that are doing and claiming to do the same thing, if not better than Ethereum. Sui is claiming the fastest time to finality in smart contracts in blockchain. And of course, Solana was one where we saw huge growth, 50%, when it went from around $100 to, over 150. then 200, 250, started really heating up. And why was that? It was a uh, layer that was very popular with meme coins. And I know we malign meme coins a lot on this show, and I know we're not unique to criticizing them because the whole idea of meme coins are kind of a casino culture, get rich quick. At least that's what they are on their face. But they can also provide some real utility. They can provide a way to both monetize and create an actual value about likeness and on social media. So these are things that can provide things like an instant funding or bootstrapping or potentially providing some sort of immediate ease on things like a donation for disaster relief. So there's some real utility here, and they can be provided very quickly on chains like Solana. However, today, I think that the use case hasn't really fully been exploited to how good it may be with the underlying technology, albeit there are challenges in Solana that will have to be ironed out specifically on the security of the chain. So we saw that the BTC momentum had kind of dragged down. Ethereum has really cut in half, and really a lot of this is just because there's more competition out there. And as we look at and survey the investor landscape, this is definitely a pervasive trend. Folks already know about Bitcoin. We covered this on last week's episode for those that caught it, where the overwhelming number, over 500 institutional investors, financial institutional investors, have already said their interest in investing in Bitcoin, with the majority of those investors looking at allocations of around 5%. Here at Morgan Creek, we've always been championing this idea of getting off zero. And really that means, single digit allocation, anything greater than zero. And, to go up to 5% is certainly a good conviction that we believe could make a lot of sense depending upon your goals in your portfolio and other holdings you may have. But with Ethereum in particular, it hadn't really had that same explosive growth as BTC. So BTC is at or near its all-time high now within reason. Obviously, it's below 100,000. But relatively speaking to Ethereum, which had all-time highs 2 or 3 times where it currently is now, it really speaks to the idea that Bitcoin maintained itself as, number one, being the oldest blockchain that we see today, the oldest cryptocurrency, but that also it became a little bit more specialized in the world of storing value and sort of financial investment for many people. Whereas Ethereum has an element of that, it's still relatively early. It's not the first, and certainly it's not the last, as there are many new chains that come on every single day that we bear witness to. But in its claim of being this other app layer, it invited a lot of competition with the likes of Solana, with the likes of Sui, and a whole host, avalanche, of other blockchains that can do very similar things, and in part with some better technology. Now, what's interesting and what I like about Ethereum, and this is a little bit of a controversial point, especially as it relates to something like Bitcoin, which is fundamentally different, is Ethereum can be upgraded. And I think about my own use of computers and, kind of growing up building computers, both with hardware and software. Upgrades were the coolest thing that you can do, right? Because you basically get a box or a tower. It has a motherboard, and it's like Legos. They're empty slots where you can just drop in different hardware that can allow you to have better performance in your PC, from memory to storage space. Now, there comes a time when the software can only be so good with the legacy hardware that you have. So that means if, let's say, you get a new operating system or other software on your computer, maybe your CPU or even your disk space might not really be compatible or perform optimally with the newest software. Sometimes it's just not even supported at all. So you have to get brand new hardware. So when I think about blockchains that have the ability to be upgraded, I think about this as real staying power and an ability to just continue with this long-term trend of upgradability that I've always seen in computing. And as far as kind of other stories that are happening, again, we're recording this on Friday. Last week, as everybody knows, I've been calling 2025 the year of mergers, acquisitions, and IPOs. For a long time, we have not really seen the classic amount or even an average amount, certainly well below average amount of exits in venture-backed companies. And I think this really creates a bit of a stain on our industry because folks look at the rising valuations of companies and they start thinking, okay, that must mean that the company has a really good chance of doing well into the future, right? Because it's red hot. But we saw that that's not always the case with the Great Reset in 2021. A lot of those valuations came tumbling down. And only in the last couple of years have we regained some footing, but it's mostly been driven by a lot of large AI deals sort of bring up the rolling average of most of the companies in VC. Now, there are exceptions. There's some sectors that are doing okay. But on the margin, we are below the all-time high that we had a couple of years ago. So how does this relate to what's happening now? Well, things are beginning to thaw a little bit. And one of the first indications of that thawing is CoreWeave. So CoreWeave is an interesting company. So CoreWeave initially started, as many of you know, as a mining company. And so by what do we mean by mining? Are we talking about picks and shovels? No, we're talking about Bitcoin and the idea that, as we know, if you are mining Bitcoin, you are part of the Bitcoin economy, in particular in the back-end infrastructure that will validate the transactions on the blockchain, preserve the integrity of the blockchain, and for your troubles, you're rewarded in that bright, shiny, newly minted Bitcoin that you get as a result for the privilege of validating the transaction if you are lucky enough to win. Because as we know, there are many miners, and also it's an extremely competitive and costly pursuit, which is why CoreWeave decided to exit this business. But instead of just abandoning ship entirely, they decided that they could use some of the technology, hardware, and learning and expertise that they had in tech and in mining and pivot into another fast-growing area, AI. And so they became one of the go-to picks and shovels AI company with very large, important customers, highly concentrated customers at that, with Meta and Amazon. But they have distinguished themselves as now being one of the companies to watch here as they have finally IPO'd earlier on NASDAQ. And spoiler alert, it did not go as planned. After its IPO fell below the range, it priced and offered really kind of a negative signal in demand for AI infrastructure stocks. But we had already kind of seen this coming, right? We had seen some of the shine, some of the luster of the big AI companies start to glean back a little bit. And this went all the way to NVIDIA. And when the little Chinese startup called DeepSeek debuted their fancy new model, which previously nobody had ever heard of except for a smaller group of people, certainly not a mass group of people that were more familiar with OpenAI, and therein, by extension, NVIDIA, and using that latest and greatest H100 hardware, the GPU chips that will power the back-end technology of OpenAI, it caused a huge shock to the system. All of a sudden, people started thinking, well, do I really need to continue valuing NVIDIA at almost 40 times earnings when company DeepSeek is performing perhaps similarly, if not almost as good as OpenAI, which buys a ton of NVIDIA and the newest chips, whereas DeepSeek was relying upon older chips and just using better software. So if we go back to that analogy I was giving at the start of the show, building computers, you get to an efficient frontier, right? Where your hardware can be enhanced by the software that you have. However, you come to a point where you'll need to replace that hardware if you have new demands put on the system. And at this point, the broader market sense is that we haven't reached that point, right? We haven't reached a point of folks needing to buy new chips in mass. As DeepSeek showed us, there's still a lot of juice left to squeeze in some of the older chips that companies and startups can use to optimize their AI engines. So what does this have to do with CoreWeave? Well, NVIDIA is a huge investor in CoreWeave, and they own around 6%. As of the IPO, they bought $250 million worth of stock at $40 a share to really anchor this. And guess what happened to NVIDIA? Their stock went down almost 2% again, and that moved them back towards the 6-month low of 104.77 cents, $104.77 back on March 11th, where then the stock fell 2% on Thursday and then 5.7% on Wednesday. So this is part of this story of this AI sell-off, and that's why some folks call this the AI gold rush, with this idea that there needs to be a rush to be able to buy and secure the asset before it just disappears. And I think this couldn't be further from the truth, because really what AI is doing is providing a new outlet for research and development. Mark and I recorded a show a couple months ago, one of my favorites, where we labeled it as AI, the 70-year overnight success story, right? And so this idea that it took 60, 70 years to create this technology is obviously at odds with this idea of being an overnight get-rich success story, which investors have to flock and buy this publicly traded company that produces AI, whether it is NVIDIA or it is Microsoft or pick your FANG company. They all do a little bit of AI. Or if you're an investor in the private markets like myself, that means bidding up valuations on startups that are involved in AI. But CoreWeave is really a pure play on AI, right? So it's testing this in this current moment in time, investor demand for AI infrastructure. And so, where do we stand, right? So let's talk a little bit more about them. So their revenue jumped more than 700% in 2024 to 1.92 billion, right? Huge number, certainly larger than many software numbers. The challenges within hardware, you do have larger typical costs than software because you actually have to buy something physical, right? Ship it, use it, install it, maintain it. So that led to a net loss of $863.4 million for CoreWeave. But as we mentioned before, they've got some pretty fantastic customers. 62% of their revenue came from one of the biggest companies in the world, Microsoft. And there is some fear that Microsoft could be curbing some of its AI data center plans. And we always thought this was so funny. Their appetite for AI is seemingly insatiable, right? Because what is AI enabling a company like Microsoft to do? AI is enabling Microsoft to sell what it sells best. And that is Office software that we all cannot live without, whether we want to or not. I, right now, am recording this podcast on my trusty ThinkPad. And what is the operating system of choice for the ThinkPad? That is Microsoft Office, as well as the whole Microsoft suite of applications from Outlook to Word to PowerPoint. You get the idea. We all use this stuff every single day. But there are challengers to the Microsoft hegemony, obviously Apple being the most notable, but then also some open source solutions and things that are cloud-based, like Google Docs, which I also use and enjoy for different reasons and applications. So if I have AI embedded in my Microsoft solutions, if I'm CEO Satya Nadella, what does that allow me to do? That allows me to sell more software. It allows me to sell more Microsoft Office and allowing my software to perform better than competitors because my AI might help them write crisper emails, might help them clean their inbox. Coming back from baby number 2, my inbox is flooded and I could really use the help of AI. I have some, by the way. It's called Superhuman AI. It's good, not great, but it allows me to at least reduce the inbox by, let's call it 20 or 30% in terms of what I don't really need to be looking at and focus more on things that I do. And if I need to transcribe an email, for example, it probably reduces that email time to finality by about 15-ish% if I had to guess, 10 to 20% or so. Now, if we look at why Microsoft was so insatiable, I think this was at the height when companies like Amazon said that they were even willing to invest in nuclear power. And perhaps I'm just a little bit of a classics when earlier on, I was always taught kind of business 101 strategy, don't deviate too much from your core. So if I'm a technology company, software company, or in Amazon's case, I am a e-commerce retail giant. I am very worried if I'm all of a sudden talking about nuclear power, when nuclear power itself is a very challenging and difficult and often divisive topic. So the idea that a company like Microsoft is backing away from its reinvestment in AI data centers, which will then touch a company like CoreWeave, no doubt affects the stock price of CoreWeave because that is the majority of its revenue. But still, let me not be so negative here. We've finally seen one of the shining new IPOs we were hoping for. And almost $2 billion is nothing to sneeze at, right? So the valuation is $20 billion, with $1.5 billion coming in, 37.5 million shares at $40. Now it's below that target, right? They were initially offering 49 million shares at $47 to $55, trying to raise 2.7 billion. But I believe that AI is here to stay. I don't believe that AI is going to come at the expense of things like blockchain or even quantum, which I'm a believer in. I think that these things will be symbiotic. There'll be overlapping technologies, complementary technologies, which will just allow users to do two things. Again, if I'm Microsoft, sell more software, do it easier and cheaper and reduce my costs while I'm doing that. Now, kind of the next thing in the IPO world, a little bit less known, a little bit less splashy than something like CoreWeave is Siemens. So Siemens, the German company, they completed a $10 billion acquisition of Altair to strengthen their digital twin and what, you guessed it, AI capabilities. So they have finalized this deal. And I think this, again, is further proof of what I've been saying for quite a while now. And that is that in a world where you have limited IPO activity, and I do think it's coming back, by the way, but I just think we're caught in this moment, you're going to see corporates that have now pushed their multiples while their EPS have been relatively flat year on year. It's going to push them to justify their multiples and their stock price, and they're going to have to turn to acquisition to shoot that gap. And so this is a perfect example. And so now, what is really the detail behind Altair Engineering? So they're enhancing this HPC, that's shorthand for high performance compute, and simulation capabilities. Really, so it is allowing Siemens and their platform to create these industrial AI and digital twins. And, the whole idea behind digital twins are now if I'm a company like Siemens, I'm huge into manufacturing and I have physical goods everywhere. So if I'm creating new products, I'm already using, way back when things like CAD, computer assisted design, and more digital environments before I can do the more expensive, costly, and most importantly, immutable things like actually making something. So if I am adding to that capability of being able to simulate things in a digital world, as well as creating that digital representation of that physical good, well, then that's going to reduce my expenses. Coming back to the idea of AI being good for two things, increasing sales or reducing costs. And now this also further cements its investment in the U.S. I think this timing is very fitting. Obviously, Siemens is a German company, and they've committed over $100 billion in the past 2 decades for that purpose of U.S. investment. And I think this is good timing. Right now, it's a good time to invest in the U.S. Very favorable and very lauded abilities for companies to come back, do business in the U.S., and particularly in the world of tech and in our world. And we're seeing that occur across the board. And companies that are international, it's a great sign for them to keep looking at the U.S., look at acquisition deals like Altair. And, what this could mean for the future is hopefully we're at a slightly different point of the exit cycle, where if we saw that compression that was happening in the number of deals in IPOs, in mergers and acquisitions over the last couple of years, right now, we're almost through the first quarter of 2025. We've got CoreWeave. We've got companies like Altair. We've had a couple of acquisitions in the crypto space, which we've mentioned over the last couple of weeks. Q3 can sometimes be a little bit of a slow period. Folks are on vacation, especially if in Europe. The vacations tend to be a little bit longer. Just kidding. They do a lot of great work out there as well. But in Q2 and then, of course, Q4, those tend to be very, very active periods for this kind of stuff and activity in the market. Now, in other news, this is going to segue a lot into our chart of the week. Don't forget, or don't think that just because my partner, my friend Mark, is traveling that we won't have a chart of the week for you. No, of course we will. And it's going to be one that will relate very nicely to a couple of the stories that we have spoken about over the last couple of weeks. And before we kind of get into that chart of the week, we'll talk a little bit as we segue into some more crypto stories about what is happening over on Capitol Hill, in particular with some of the regulatory framework that is now trying to be in place for our crypto industry. Now, I think it's so funny, and I talk about this with Mark quite often and the rest of my team with Sachin and other members, is that crypto started off as an industry that by design was trying to provide an outlet from oversight. It was trying to go peer-to-peer. It was trying to avoid institutions, and that got it pretty far. It didn't get all the way towards bringing about this new future where we don't need banks or we don't need watchdogs or overseers, but it got far enough to be able to create and develop that technology to where now it is an immensely large and valuable asset class. If you sum up all of digital assets, right? Extremely, extremely valuable, huge number. But it's no longer capable of operating like it was designed to be, this peer-to-peer without oversight. And now many of those same captains and champions and founders are clamoring for regulation. We've started to see it. We have our first crypto president, quote unquote. But there still is a little bit of tension. And I wish this tension wasn't so far in its partisan divide. But unfortunately, that's the reality that we have right now in the U.S. And there's different stakeholders in each side of the fence. But overall, I think the people have spoken, right? When we saw more than 300 pro-crypto lawmakers join as newly elected officials over the past election cycle, we've also seen Texas make moves in using a digital asset strategic reserve and, of course, the executive order to create a strategic digital reserve. But now is when we have to actually color within the lines, right? In order for this thing to really take off, this thing being the mass adoption and consumption and evolution of digital assets, this has to be colored in. And so where do we stand now? So Paul Atkins, he was President Trump's nominee for the SEC chair. He is taking serious heat, in particular from Senator Elizabeth Warren, a longtime outspoken critic of digital assets. And so she is raising potential conflicts of interest due to his $6 million in crypto-related holdings. And so Atkins is a former SEC commissioner and Wall Street consultant, and he advised many crypto funds like Anchorage and Securitize. These are big names in our industry. And he has pledged to divest from these interests if confirmed. So that really is trying to do two things. Trying to get somebody who understands the technology and is trying to also protect the American people, trying to replace some of the policies of former SEC chair Gary Gensler, who really made his mark in our industry as somebody who was greatly opposed towards the large and steady advancement of digital assets, although we did see the passage of the ETFs last year, which were highly successful, right? We saw the passage of Bitcoin in particular and Ethereum, which was slightly watered down because you couldn't do all of the great things that you can on Ethereum, such as gaining yield from holding the asset. You can only buy and sell ETH through the ETF. But you did see over 100 billion worth of inflow into those ETFs, including one of our portfolio companies that was given one of the 11 exclusive slots to be able to buy and sell ETFs into the open market, which was Bitwise. So Warren is calling for further commitments and recusals from crypto-related cases. And I want to be careful here. I want to be fair to the folks that want oversight, because there is fraud that happens in the world of crypto, just as there's fraud that happens in the world of email. But we need to not be as critical about a policy of advancing technology, which will ultimately franchise many, many more people than it will disenfranchise. So we do need to have those oversights in place. We also need to make sure that we have the right people in place. People who understand what they're talking about. People who have experience with the asset, and not necessarily condemn those people if they might have prior involvement with large groups in the Web3 space that ultimately gives them the knowledge that enables them to perform their job. So let's keep an eye on this. It's not something that will be solved today, but it's something that is very active in our community, where the balance of power right now is definitely tilted towards more pro-crypto and potentially more positive regulation in terms of enabling the flourishing of Web3 related technologies and digital assets in the US. Let's make sure that we continue doing this the right way, having people that are qualified in these positions that are free of entanglements, but that also, and this is my own selfish interest, keep enabling and advancing the technology to enfranchise the greatest number of people. Now, I think I've teased it out long enough. In this chart of the week, I'm sure many of us have either heard of or have seen the movie Dumb Money. Dumb Money is with Seth Rogen and a couple other guys at, I don't know their names right now, but I know Seth Rogen because he's hysterical. I've seen a lot of his movies. And what the movie is about is the great episode of trading during the pandemic where GameStop, a company that was literally on the ropes, seemingly out of nowhere, driven by the Reddit army, which is a social media platform many other people use to spread ideas. And then this Reddit army, driven by one guy, they bought up GameStop and they forced a short squeeze to basically bring the hedge fund community to their knees. And this was kind of something that nobody saw coming, right? An ability for retail-style traders to take on sophisticated, well-capitalized hedge fund giants and successfully win. Although, I don't want to spoil the movie too much, but this is more just history here. As this started to happen, Reddit army, which primarily had traded on a platform called Robinhood, which we know very, very well. We spoke about what's happening with them in particular in the world of crypto, where they recently bought Bitstamp and enabled this greater advancement of trading. Prior to that, they had a lot of the other coins on there as well. But they actually paused trading and outflows during this time, and it caused a huge panic, and it caused a huge alarm bell to be sent off in the broader community that's saying, hey, this isn't fair. But GameStop is back, and they continued to fight another day, and now they're taking a different playbook. And it's a familiar playbook for those that listen to Digital Currents because it is the MicroStrategy playbook. A MicroStrategy, you may remember this company as the most successful U.S. stock over the last 5 years. MicroStrategy was previously effectively just a technology company, almost a dead company, shell company, an empty holding, a legacy mainstay of the dot-com era, until they made a huge reversion of course and started buying Bitcoin. And they started printing more convertible note debt in exchange for capital to buy Bitcoin, and investors flocked to that because many of them thought it was easier and cheaper to buy MicroStrategy than buying Bitcoin itself. And so now GameStop wants to get in on that action. And they have plans to privately offer $1.3 billion in convertible senior notes. And this is astounding, right? So this is going to not pay regular interest. They'll mature in 2030. And there will be a general unsecured obligation of GameStop. And so they have said this plain and simple. What is the goal of offering $1.3 billion in convertible senior notes? It's simple. Buy Bitcoin. So the board has approved investment in Bitcoin as a treasury reserve asset. So the time has come where companies that are on the ropes, but also companies that are doing well, right, will look to add more assets to their balance sheet, which can grow their long-term financial outlook. And so for a company like GameStop, this is the playbook for MicroStrategy. So here's the idea in a little bit more detail. At first, for MicroStrategy, they mostly sold really richly valued stock to fund their purchases, right? And investors were willing to pay much more for their shares backed by Bitcoin than for the cryptocurrency itself. This is what we're talking about. It's a little bit easier to just go in your brokerage account, buy MicroStrategy, than going into Coinbase and setting up a buy there. And maybe today that's changed, but over 5 years, this wasn't always the case. And also look at the type of people that are buying in this fashion. It's largely financial institutions, although as we've reported, that may shift. And so it's been fairly recent that MicroStrategy shifted towards a debt strategy in order to buy Bitcoin. This almost feels like an infinite cheat code, right? Borrow money for free, buy a scarce asset, and help push the value higher. Increase your stock price and use it to extinguish the debt, rinse and repeat. So here's GameStop, right? And they're new to this particular approach. And this is what they learned yesterday, that there's no such thing as a free lunch. And this is where I make the transition to cue our chart of the week. Normally, this is where I ask Mark if he can see my screen. But since I'm going solo, that's a bit of a redundant question, isn't it? I know there was no Bitcoin sock game reveal. There was no orange pants. I am not going to take Mark's things and parrot them. We will have to wait till next week to get the reveal. But as I always remind our listeners, check us out on YouTube where you can see this week, the chart of the week. You can see if Mark has been deep faked or if he's on his way back to Chapel Hill. And myself, I'm not going anywhere. I'm in my Jersey basement while my 2-week-old is resting safely upstairs. Now, as we see the chart of the week, you've got 2 lines for those that are on audio only. Over the past 6 months, we're seeing share price. The 2 lines, one represents MicroStrategy, that's the light blue line, and the dark blue line represents GameStop. Now, clearly, MicroStrategy has performed better than GameStop in the past 6 months, and the share price gain has not just performed slightly better, it's dramatically better, right? There were periods of over 170% growth for MicroStrategy, but GameStop had some decent performance, something like about 50%. But now here is the problem, and here is the idea of there is no such thing as a free lunch. Its stock plunged, wiping more than 2.8 billion off of its market value. Yes, billion with a B. More than twice what it's borrowed. So this is interesting, right? MicroStrategy does the Bitcoin strategy. They're rewarded. GameStop does the Bitcoin strategy. They are hammered. And so one reason for that, let's think about why this could be. It could be the idea of the sheer recklessness of the idea. MicroStrategy had already proven and demonstrated a commitment over years to buying Bitcoin. And they didn't just do it at the all-time highs or close to it, right? And it was only until recently that they started using the bond strategy. Previously, they did it in a different fashion, developed a track record, showed some performance to investors, rinse and repeat. So this is kind of like coming in at the 9th inning, trying to get the save and the win at the same time with the bases loaded. It's really difficult. So sophisticated buyers like hedge funds, they don't care whether you're buying Bitcoin with borrowed money, and if that's, smart or dumb, or that the bond doesn't pay interest. But they do care that GameStop stock is volatile. And I think that's the really critical difference. It was a different time when MicroStrategy began their approach. They were pretty much dormant. They weren't really doing that much. They were kind of a holding company. Bitcoin was still relatively new in the investment community's eyes, certainly for the financial institutional investor. So options math, which helps investors price convertible bonds, it relies on volatility as a key input here, right? So more volatility means the bonds are a low risk way to really lock in value, right? And to make this financial arbitrage work, they also have to hedge the risk in GameStop's underlying share price. So the difference here is that MicroStrategy doesn't run a business. GameStop does run a business. The business of providing a stop for games. See what I did there? GameStop has an underlying business that is highly volatile. So to make the trade work, you have to hedge the risk in the underlying share price of GameStop, which is in part driven by the financial performance of the company. So they have to short the shares and borrowing and selling them with a promise to buy back later. And since GameStop's issue is more than a tenth the size of its total market cap, that means a lot of selling. Hence, a pretty big blow to the tune of $2.8 billion off of its market cap. Twice what it's borrowing. So it's kind of ironic in that the whole thing, going back to the movie, going back to Dumb Money, that kind of put GameStop on the map, right? It harnessed its retail fan base and the hatred of short selling by hedge funds, right, that were beating the stock to death, is now come back to form its undoing. Since a private offering, the convertible can't be sold to small investors, right? But it can cost them. We've done it, folks. We have done what we set off to do, continuing to stay current. We'll be back again next week. Mark will be back from his travels. We will check to see if he was okay the whole time. I'm pretty sure that he was. And I can't wait to come back to our audiences and see what the next crop of tech news around artificial intelligence, blockchain chips, and big data, what we call the ABCDs. Thanks, as always, for listening. Please, if you like what you hear, rate, review, and subscribe. Check us out on YouTube and wherever you podcast. And as always, stay current. Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.